Hello, everyone. Thank you for joining. My name is Atin Batra. I am the Director for Impact Investing at EPMC Group's Education Impact Fund. Welcome to the last session of our 2024 Floor Learning Series. I am very excited to introduce our esteemed speaker, Susan, who brings so much experience from all sides of the venture landscape. She's been an operator, educational administrator, and an investor. Susan has over 25 years of experience in private equity, investment banking, and education. She's the managing partner at Leeds Illuminate, a firm that invests in innovative solutions focused on expanding, improving, and accelerating learning outcomes. Prior to joining Lead, Susan was Chief Operating Officer at 2U. She was also a founding team member of Think Equity Partners and a partner at Best Associates. And the best part is that in the little time that I've had the privilege of spending with her, I've actually learned a ton. I'm sure today's attendees will also walk away with valuable, actionable insights. With that, I'm going to hand it to you, Susan. If you feel like I've missed something in the intro, please do add. But if not, maybe we could kick things off by saying, what are the key metrics that a business should keep an eye on?
Yeah, I appreciate that you mentioned early on bringing seasoned executives as opposed to, I like being called seasoned instead of old every time I think to 25 plus years in this industry. The good thing is that you keep coming across the same people in the industry,
Sure.
as well as a lot of the same problems and challenges over time. You get a chance to solve them more than once along the way. But no, certainly nothing you missed. I will pull up my deck. For anybody who knows my partner and better half, Elizabeth Cho, she would be horrified at the rudimentary nature of my slides. So let's
Start by talking about how you identify the key metrics that predict success for a business. How does that differ by company stage?
absolutely. Let's see. Let me make this work a second time. Okay.
I can see it.
Right. Oh, what? Maybe it'll come back up into slideshow version, but if not, all right.
Oh, there it is.
Key metrics, I think of them in three categories. What you're looking at around those different categories does change depending on where you are in terms of stage, for sure. And so happy to spend a little time talking about that. But when I boil it down to what are the things that really, whether I'm running the business or talking to the CEO about their business and thinking about how we might help as investment partners, it boils down to three big categories. One is demand, top line, growth, revenues, bookings, however you think about that. The second is sustainability, and I don't mean sustainability in the impact sense, but sustainability of the business. What are the economics of the business? How are we doing in terms of collecting cash? What are the margins look like? What's the path to profitability for the business? And third category is really around efficacy and outcomes, because we are impact investors. But I also believe that in the sector, in education and workforce development, if you're not moving the needle for the learners and workers you are supporting, then you're not building a great business. Is and should be a real driver of the top area in particular. In that first category, I'm interested in looking at bookings, revenues. Have you created something that people are willing to pay for? That's where the rubber hits the road on determining the early stages of product market fit. Are they willing to pay for it? How rapidly are you growing? How quickly are you adding customers who are willing to pay for it? How are you doing in terms of expanding those customers? Do they love the product? Do they say, gosh, I can't do without this? And so are they willing to keep paying for it year after year? Or do they try it and say, this is a nice to have, not a need to have, and churn out? Different metrics that you can look at in this broad category are bookings, revenues, growth rate, customer retention or churn, as well as customer expansion. The second category that I think about is sustainability of the business. What are the unit economics? What's your gross margin? How much does it cost you to deliver the product or service that you're selling? Um, Gross margin is high on the list because it tells you what you've got left to pay for everything else you need to build the business, acquire customers, and support everything that goes into it when you think about what's left over after the direct costs of delivering your product or service. The second big one for me when I think about the unit economics is how much does it cost to acquire that customer? Whether it's B2C or B2B, thinking about what that funnel looks like and what does it cost all in when you get to the bottom of that funnel and you've turned that customer into a paying customer. The second big thing I think about in terms of sustainability is what's your cash cycle? Is this a business where people are paying upfront for the product or service that you're delivering? Or is it something that they're paying for over time or after the fact? You think about alternative credentials companies that do deferred tuition programs or ISAs where the payback is deferred in a significant way. How does that impact the cash cycle of the business? What does that mean in terms of growth? If you're really knocking it out of the park in terms of growth, but you have a business model where your cash is delayed significantly, then it's going to take an enormous amount of capital to grow that business. So thinking about that up front. And the third thing is, what is the path to get to profitability? That doesn't mean that if you're an early stage business, you have to be there, but it does mean that you have to be thinking about how you're going to get there. And that goes back to gross margin, the cost of acquisition. What is it going to take to build a scalable business? And where do you hit that tipping point where you are able to be self-sustaining, where you are in charge of your own destiny? It's worth noting that not every business is a venture backable business either. There are great businesses that are bootstrapped, that are profitable since inception, that choose to grow at a slower rate because they want to pay as they go. There's a lot of terrific businesses that start that way. And then when they hit a certain level, think they're willing to take in outside capital so they can accelerate their growth. There are a lot of businesses that stay there. And there are also tremendous businesses, huge public companies that lost money for years and years, over a decade, that are worth many billions of dollars today. But it was clear how you were going to get to profitability. It was not a situation that you assumed that they would always be unprofitable. And then the third piece around efficacy and outcomes, it really ties to, are you delivering against your promise? Are you delivering in education and workforce development? Are you delivering the educational outcomes that people are looking for? Are you improving their economic opportunity? Are you improving their economic mobility as you're doing this? That ties back into the demand piece of it, in my view.
This is all great information. And I think it's also a really good framework for how an investor views and evaluates an opportunity. The question I was going to ask was, a lot of the folks on the call today and those who will be watching the recording are in the education and workforce space. What are some of the metrics that are unique to an education business or a workforce business that might not have been covered over here in this list?
Yeah. So within efficacy and outcomes, those are incredibly varied across this subsector. And even when you're talking about this subsector, you can slice it down into all different sorts of categories. I really look at this as, what is the promise of the company and how do we measure that? How do we define that? If it's an early career alternative credentials company, then likely most of their learners are coming because they want to get a job at the end of that. They want the economic opportunity, looking at completion rates, looking at placement rates for the program, increase in salary from pre-program to post. Mm-hmm. If it's a workforce access company, maybe a digital talent marketplace that's trying to connect companies or organizations with talent for flexible work in a variety of different ways. We may be looking at metrics around the fill rate. Are we satisfying our company customers? Are we satisfying our talent customers? Are they getting what they need when they come to us? Or you might measure it in terms of economic opportunity generated across the filled jobs, for example.
All right.
So tremendous variability when you think about those things and the leading indicators that tie to those first two categories. When you're super early stage, you're looking at a lot of leading indicators that should lead to the things in those first two categories.
But also your benchmarks are different, right? Your benchmarks for a CAC over LTV ratio cannot be the same for education companies versus a SaaS company in the broader tech space, right? How do folks go about figuring out what those benchmarks are? Do you have any key resources that you recommended to folks, or are there any numbers off the top of your head that you're always looking for?
What we're really looking for is how does that convert into the unit economics and the path to profitability for the company? Are there aspects of the business that we think are going to either reduce that acquisition cost or increase that lifetime value over time? And how do we think about that? But I don't have a rule of thumb on here's the number, and to find comparable numbers really is a little bit of a hunt, and networking and understanding the market that you're in.
Right.
Because it varies so substantially.
I think the other problem with metrics is it's easy to find something to measure, but is it the right one to measure? How do you differentiate between vanity metrics versus truly actionable metrics?
That is always a good question. For me, the key to answering that question is this data point really a key driver or a key indicator of one of those three categories that I just mentioned of demand, sustainability, or efficacy. Looking at numbers like the number of page views of your website, or even the number of users who have joined your community. That's nice when you're super early stage and you don't have paying users. You may be using that number as an indication of interest that paying customers are going to come. But once you get to a point where you do, then what really matters is how many of those people are actually paying for what you're offering. How many of the talent that are coming to your digital marketplace are actually getting jobs from that, as opposed to how many of them are coming and looking for jobs there.
Right.
Another big one is having a new logo or a contract signed means very different things in different companies and different industries. And if it's a contract that means that once we've signed this contract and we agree to move forward, my company is entitled to $300,000 as long as it delivers the product that it says it's going to, then great. Signed contract is a good metric to think about. In the workforce access business that I was just talking about in terms of a talent marketplace, signing a contract with a company that says, yes, we want to use you to help us place people in these jobs that we need. Having the contract signed doesn't necessarily mean anything. It just means that you've jumped through the hurdles on the procurement side to get a legal piece of paper that basically says, whenever we have an active job rec that we want you to help us fill, then we've got the paperwork in place to do that. Vanity metrics, I think that when you're at a very early stage, you start using them because they are the indicator. When you get a little more mature, they don't mean much anymore. But they look good on a page because they're getting bigger and bigger. And so that's how people fall into the trap of continuing to show those numbers that don't necessarily drive anything in those three categories.
The thing that I'm taking away from what you just said is, what is a metric that proves value prop?
Yes.
Maybe your value prop is that you need lots of eyeballs on this. And if that's your value prop, then fine. But what is your value prop, and what is the metric that you can tie to that? And what is the smallest unit of that value prop? So like the active job recs, I think is a good example of that. Just breaking it down into component units and saying that is the metric that truly proves my business is moving forward.
That's exactly right.
One more question, the definition of metric before we go on to other questions. How do you think about quantitative metrics versus qualitative metrics? There's so many times, and we've recently seen this in a number of investment opportunities. The biggest differentiator is user experience. When user experience is not really quantified, how do you think about those kinds of metrics?
A great user experience should actually feed back into all that top line on piece. If it doesn't, then is it really driving value? You can have a great user experience and still have people saying, I love the interaction here, but I'm still not getting what I need, so I'm not going to renew.
Right.
Ultimately, I think that even the qualitative has to tie back to one of those three categories. So I see, but the qualitative pieces are the necessary building blocks to get to those later metrics. And customer satisfaction, customer enthusiasm, referenceable clients. The referenceable clients piece is a big reason why people use NPS instead of a satisfaction score, because if you're satisfied with what you're getting, it's one thing. But if you are enthusiastic and willing to go be a reference or actively promote this product or service, that's a whole different thing in terms of what you can expect out of that level of customer satisfaction and engagement. I think about a company that I was CEO of earlier that does programs around research-based teaching techniques for faculty in higher ed. Dirty little secret in higher ed is that we don't teach faculty how to teach, except that it's not really a secret and nobody feels that bad about it. But the reality is that if you share research-based techniques with faculty, give them the opportunity to practice those and really change their behavior in terms of what they're doing in the classroom, it has huge impact on student success, on persistence, retention, graduation rates, all sorts of things. Not to mention how happy they are in their experience, how much they like that faculty member. But one of the things that we used as a qualitative metric for the faculty members who were going through the program was a metric around what's your increased confidence in your ability to put this practice into your own classroom. And so we measure that, what's your confidence level before you go through this module around this technique, this teaching technique, and afterwards. So that is definitely a qualitative measure. And it's not the same thing as asking, did you like this content? Or even, would you recommend this course? It is, do you feel better prepared to actually do the thing that you're taking away from? That these qualitative metrics can be really important, but ultimately, I would argue that even that increased confidence of the faculty member who's going through that course, that has to tie back to demand metrics, buying this more because of that. Are you retaining customers more because of that?
But it could also reflect in like learning outcomes, like your increased confidence on the part of the teacher. Does that lead to increased learning outcomes for your learners?
That's exactly.
And that is like a through line that you can feel.
Absolutely. And that company, we did tremendous amount of really rigorous research around showing the better learner outcomes for faculty who had been through this program versus control groups. So,
yeah, that's helpful. Again, what I'm taking away from this is qualitative metrics are helpful and we should measure them and there's value in them, there's signal, but when possible, as best as possible, also try and connect those to some kind of quantitative metrics, going back to our earlier discussion.
Anything you can quantify, you should.
Fair. So two more aspects about metrics that I want to cover before we open this up to questions. But one is, how do you prioritize KPI as a leader of a team? How do you think about that? And then the second piece is about accountability. Once you prioritize, how do you hold your teams accountable. So let's talk about those two things.
Yeah. Focusing on the right questions is a big deal. And we talked a little bit about how maybe you shift in terms of what are the questions, what are the KPIs that you're looking at as you mature as a business when the leading indicators are not as relevant as you grow and have more data points that really tie more closely to it. One of the biggest things that I think about in terms of focusing on the right questions is around sort of trade-offs and goals. And for a lot of companies, particularly growth stage companies, which is where Leeds Illuminate invests, over the last couple of years, as the market really shifted from valuing growth very heavily to, yes, we really value growth, and you really have to do that sustainably. And you need to shorten that path to profitability and have more focus on cash cycle and all of those things. And so for leaders of companies that were being measured by their investors or their potential investors much more heavily on that first bucket, that demand bucket, gross revenues, bookings, to a more equal focus, that sustainability bucket, it really did mean that you have to revise how you are defining the KPIs, how you're emphasizing those, and how you're communicating those to your team. And the communication of it, I think, is really critical in terms of accountability. You have to be clear with people. Can't follow. You need to when you've gone through a process and you've gotten input from your team around what are the right metrics that really drive those key buckets, then getting that input should help drive alignment from the team and agreeing what the right focus is. And then you have to, a great leader has to communicate clearly, okay, these are the things that we are focused on to really measure our progress. And you have to do it over and over and over again. Every week, every all hands meeting, every executive team meeting, focusing in on that, making sure that you're measuring it, that you're showing it, that the data is accessible, that you're being transparent with people about how you're doing against those metrics. So that you're aligning your in compensation to the things that you're saying are really important, because you get what you measure and you get to pay for incentive compensation, and really being thoughtful about how all of that plays into your ability to drive those is really critical. The last thing I would say, how do you keep people accountable? How do you keep people enthusiastic is again about visibility, transparency, celebrating wins. I work out at a gym where we do a lot of strength-based training. And if we're doing a baseline and I manage to do one more rep of chest press this time than I did last time, or I go up one weight class this year in the shoulder press, that's worth celebrating. It's not a lot of movement. I'm not ever going to go win any competition or anything, but that's progress. And the same thing in companies. If these are your key indicators of how you're progressing, then celebrate positive movement, even if it's small, and celebrate creativity and innovation that links to ways that we can drive these metrics more. Because even if it fails, even if it doesn't work, you want people to be really leaning into these measures and doing everything they can to drive them.
Right. Joe, who runs our team, and you know very well, Susan loves to say, show me some of the incentives and I'll show you their behaviors, which is essentially what you just said, that you can identify the metric, but then align your team and align your incentives to ensure that you head in the right direction, which is important. One last question I'll ask you before I do that, though. Folks in the audience, if you have any questions, please start throwing them into the chat and into the Q&A section. We're going to move to those right after this. But the last question that I have for you, Susan, from my original set is, as you think about metrics, there's leading indicators. And they're leading indicators for a reason, because they're leading and you're not right there. And so how do you think about time lag between some of the metrics that you're measuring versus truly being able to tie them to business outcomes?
Yeah. It is a challenge. And so that's why I said that even those qualitative metrics, I need to be able to really understand how they truly tie to outcomes in one of those three buckets. Because I might have a hypothesis that a great user experience and a really high level of satisfaction around that user experience is going to be a driver of growth. And so I'm measuring that, I'm tracking that as a leading indicator. You need to be testing that over time of, is it actually doing so? Are you seeing the revenues coming from it? Are you seeing the retention because of it? Um, when people are buying what you're selling and are staying with you, do they identify that as a key reason that they are doing, or are they telling you that it's actually these other pieces that are the drivers for us? So you have to constantly evaluate and be honest with yourself about whether your original hypothesis was correct or not around those leading indicators based on, are they actually leading to what you think they should?
Got it. That's helpful. Thank you so much for answering all of my questions. I know folks have many more, so I'm just going to open this up. We've got a couple of questions here, and I'll just read them out to you, Susan. So Pete sent in a question. He runs a B2B workforce training company focused on companies with frontline workers, have created over 6,000 courses, 12,000 users. They've raised a pre-seed, it sounds like, of 280,000 for product-led strategy, and are about to go out for their seed round. What he's trying to understand is, what is the KPI that he should focus on? And I'm going to make an assumption, but I'm assuming, Pete, you're also saying, what kind of KPIs will help you with the fundraise going forward? And so what should they focus on, and what should he be measuring actively?
Yeah. So some of the questions that I would have for you if I were digging into your business is, I'd want to understand more about how many of those courses are people actively engaged in? Are they clustered in a smaller subset of those, or is that full breadth of it needed, and do you need to continue to grow that? The users on the platform, how active are the users? Is it if I've sold it into a company and they have bought 500 licenses, for example, how many folks are actually showing up, going through the courses? How many are showing up at the beginning versus completing? Because if I'm a B2B customer, year two, those are some of the things that I'm looking at to determine whether or not I'm going to pay for those 500 licenses for the next year. Are there paths that people can grow in so that those learners are using what you're offering for multiple courses? You've got repeat customers effectively who are coming back and really, really digging in there. The things that lead to stickiness with your B2B customers would be an area that I would be particularly focused on in terms of metrics for your company.
We've got Pete here, and Pete, if you have any follow-up, and I'd request you to be brief, but if you do have any follow-ups, why don't you go out and throw those, and we'll see Susan.
Thanks, Etienne. Thanks, Susan. This is real helpful. We do have some of it. It's very interesting. Some of our customers have high engagement with the platform. Others, not so much. We're a community micro-learning platform. So what's interesting is the companies that have opened up the platform to more members to be able to create content tend to be more active. And the ones that have done the traditional top-down LMS, because we can be used that way, those tend to be less active. People take the courses, they finish them because most of the time it's mandatory, but they don't come back in for refreshers, or they don't come back in and comment. So it's a mixed bag on engagement. We do have a very high retention rate, though. Our retention rate we've really only lost one customer in the last 3 years, and that's been to a company that's basically filed Chapter 11s. In that regard, I feel strongly that we've got a great solution, but your observation of engagement's a good one. I think and we recommend often to customers to open those communities up, but a lot of people don't want to do that because they're scared of what they're going to get.
I totally get that. I would lean into the fact that you've got multiple years over X number of customers that show that this is that the companies are getting more out of their investment by opening it up, going to them with here's best practice for implementation, and taking it. Sometimes you have to meet folks where they are. But as you build more credibility as you build your business, leaning in hard on, I hear what you're saying, and I'll tell you based on our experience that 97% of the time you get more engagement and more value if you implement this according to ABC in terms of our process.
Yep. Thank you, Susan. Appreciate it.
Absolutely.
I think the other thing I might add, and this is completely unsolicited, is if your consumer base is genuinely like that over 3 years, only one churn, then I might also just look at net dollar retention. Have you been able to expand within those customers? Because if it's the same amount of revenue over a couple of years, then that's also not a great sign. It's a sign, but not a great sign that sort of gets you excited as an investor. I don't know if you disagree with that, Susan.
Not at all.
All right.
Yeah, I would say that's why we're trying to raise money is to get more leads in the top of the pipeline. That's
Right.
that's 100% of use of funds. So I totally agree with that as well.
All right. Thank you, Pete, for asking that question. One other question that I've got for you here, Susan, this is from Tusheen. She's asking, can you share a couple of examples where metrics have revealed insights that have significantly changed a company's direction? So what are some metrics that, unconventional perhaps, that sort of told you something that is different?
Yeah. I talk about a company in the workforce access area. This is a company that is connecting employers and talent for project-based, both short-term project-based and full-time work. And they serve small and medium-sized businesses, SMB, all the way up to Fortune 100 companies. And their SMB segment had been large number of customers, large number of successful placements. It's a busy and successful team, been a meaningful percentage of revenue for the company over time. The jobs in that SMB category are largely part-time, project-based work. Might be 20 hours a week for 3 months or 6 months or 12 months or something along those lines. And really digging in that. And so if you were just looking at the top line, the demand side of the metrics, lots of good things happening in this segment of the business. And if you were just looking at customer satisfaction or efficacy, good things happening, getting people placed, getting people jobs. Companies are getting the talent that they're looking for. They're happy with that. Everything's worked. But we worked with the company to do some analysis that really dug into the makeup of those individual jobs or individual placements in the S&B side, and found that there were an awful lot of them. A majority of those were for folks that were working less than 10 hours a week and at wage rates that were under $30 an hour. And this company makes money on the markup on the talent effectively. And so if it's a lower wage rate, the percentage might be the same, but the dollars
Right.
are not that much to pay for all the other things that go to making that business work well. What we were able to see really clearly is that for a large percentage of those placements, they were margin negative to the company. And so in that category, those were job wrecks. Those were placements that we shouldn't be doing if we want to stay in business. So what that led to was a redefinition of the ideal client profile, different minimums in terms of weekly hours worked that a company is looking to source for, to make sure that even if we are filling fewer roles, that we are doing so in a way that's going to be net positive to the margin positive to the company.
I think that's also an interesting example of, and I'm not always in favor of this approach, but also a personalized or a customized metric that is suitable for your company very specifically. And it's in this particular case, it might be a revenue per worker or revenue per, like whether that unit, how do you think about that? But
That's right.
and that's not something that is commonly listed in listed metrics, but it is relevant here to your point. That is what actually truly shows what's happening in the business, because that is core to the driving, and it's a driving sort of lever to the business.
Right, exactly right. Number of hours worked, active talent in these placements is a huge driver. Is this a good piece of business for the company or not?
Yeah, so definitely not in favor of the community adjusted EBITDA approaches, but
No.
Here it does make sense. Fair. I have one more question here, and I think we have only time for one more. But Travis asked, what are the big red flags that you see as an investor when you're evaluating the metrics that companies are putting up?
Two things that I would say are the biggest red flags. One is if we're given some metrics and then we ask follow-up questions to try to dive deeper into them, like what I was just talking about, to peel back the onion to get at what are the building blocks that get us to metrics, and the company can't deliver those, because then you worry about either how deeply do you understand it, or how are you doing, how are you managing your data, which is often a challenge as you're growing. That's if you can't go the next couple of layers deep on metrics that you say are really important to the business, then I see that as a red flag. And the other red flag is when founders get really defensive or unwilling to dig into things that don't make sense. I look at two metrics might on their face be different, but there's some linkage. And as you dive into that, if you get a lot of pushback and a black box approach, and that's probably not the right partner for us.
Sorry, the one that I apologize, I'm adding my stuff to this, but
I'm glad.
The one thing that I've always thought of and you mentioned this in the first red flag, is looking at underlying data set. I think the one piece that we also see a lot very often is just not having statistically significant data.
Oh,
you can say that it's improved, but if it's on the base of that, does it really truly matter? And is it like a really good signal? So I think that, again, to your point, like from an underlying data set, like you have to be able to share and defend the metric that you're putting up and building your concern.
And if it's not yet statistically significant, that's okay. If you're really early stage, you may not have data for it to be yet.
Just call it up. Yeah, exactly. Just that's the caveat, and then say it. And that then goes back to the other point that you raised, which is when people start to get defensive about it. But that's fair. Thank you so very much, Susan. This was amazing. I enjoyed this conversation. I learned a lot, and I'm sure folks have as well. As I mentioned, this is a recorded session, so we're going to put this recording out. We're trying to identify some key takeaways and have some clips for that as well. If folks want, they can actually look you up on your website and Leeds. And I don't know how many of folks here are far along enough to be in your sweet spot, but if friends who are, please do definitely recommend them to look up Leeds, who is definitely one of our favorite GPs as a whole. So again, yes, thank you so very much, Susan. This was great.
Thank you. It was a real pleasure.
All right. Thank you.